There is a precise moment when a price tag stops being just a number on a screen and starts becoming a warning system for the global monetary order. When gold quietly surged past $4,500 an ounce, it did not happen because mining operations suddenly ground to a halt or because jewelers rushed to buy up physical metal. It happened because the primary anchor of the global financial system, the United States dollar, is experiencing a structural shift that institutional capital can no longer ignore. For decades, investors were taught that gold was simply a hedge against temporary inflation or a crisis asset to hold during geopolitical panics. But when a pricing milestone of this magnitude is breached during a period of relentless sovereign debt expansion and shifting reserve policies, it signals something far more profound than a temporary market swing. The metal itself has not changed. What has changed is the purchasing power, the credibility, and the long-term calculus of the paper currency used to price it. Yesterday, we traced how a single embedded line in a Federal Reserve statement began quietly altering institutional perception around silver, turning what was once treated as a hybrid industrial asset into a strategic reserve candidate, sitting right next to gold and digital alternatives like Bitcoin. We examined how rising real yields had initially punished non-income-bearing assets, triggering a sharp reversal in gold before capital began recognizing that central bank language was shifting from standard monetary mechanics to long-term currency concerns. That systemic interplay highlighted how institutions move long before retail investors catch on, methodically positioning for a broader repricing of safety. And if you have been following along from Toronto, London, Singapore, or anywhere else across the globe tonight, drop your city in the comments below as this global shift touches every corner of the market. Today's chapter picks up directly where that realization leaves off, because as gold breaches historic four-figure thresholds, the true catalyst sits not in the bullion vaults of London or Zurich, but inside the balance sheet of the world's reserve currency. To understand why $4,500 gold is fundamentally a story about the dollar, one must look at how reserve currencies historically behave in the late stages of massive fiscal expansion. When a central government incurs deficits that outpace real economic growth for extended periods, the central bank is eventually forced into an unspoken dilemma. Either allow interest rates to rise high enough to suppress inflation, which risks suffocating sovereign debt service, or keep liquidity conditions flexible enough to digest the debt, which continuously erodes the currency's domestic and international value. When institutional treasuries, sovereign wealth funds, and global central banks look at the long-term trajectory of national balance sheets, they calculate what is known as real debasement risk. They are not merely asking what inflation will do next quarter, they are asking what paper fiat will be worth relative to finite physical assets over the next decade. This calculation creates a deliberate, quiet migration of capital. When the market begins pricing gold at unprecedented highs, it is essentially executing a real-time vote of lower confidence in the future purchasing power of paper currency. Historically, when the dollar strengthened on a nominal index, gold faced persistent headwinds, because a stronger dollar made commodities more expensive for international buyers. But in recent cycles, that classic inverse correlation has cracked under the weight of structural central bank buying. Sovereign nations are increasingly settling cross-border trade in alternative currencies and accumulating physical gold at record speed to insulate their balance sheets from foreign currency sanctions and purchasing power decay. If you find this deep macroeconomic breakdown valuable for navigating today's markets, make sure to subscribe to the channel and hit the notification bell so you never miss an episode in this series. What we are witnessing today is not a speculative bubble driven by retail euphoria. It is a mechanical rebalancing executed by some of the largest pools of capital on Earth. The $4,500 threshold is simply the visual evidence of that rebalancing taking effect. As sovereign capital quietens its exposure to paper assets, the dollar's erosion is no longer reflected merely in standard consumer price index reports. It is increasingly visible in the fundamental price re-anchoring of non-sovereign reserves. When gold established its foothold above $4,500, institutional trading desks began recalculating the shadow price of fiat balance sheets. For more than half a century, the primary lever for dollar dominance was the willingness of global counterparties to hold U.S. Treasury debt as a risk-free benchmark asset. But as domestic debt service costs escalate into trillions annually and public deficit projections show no structural deceleration, holding low-yielding or negative real return sovereign bonds has transitioned from a prudent risk management stance into an explicit drag on purchasing power. This environment has fundamentally altered how foreign central banks handle reserve accumulation. Rather than recycling surplus trade revenue exclusively back into Western sovereign debt, global monetary authorities have executed a persistent multi-year pivot toward physical bullion. This is not speculative capital looking for short-term trade. It is systemic risk management happening at the highest levels of global finance. When central banks buy gold, they are accumulating an asset with no counterparty risk, no jurisdiction risk, and no susceptibility to central policy devaluation. As this structural bid absorbs available physical liquidity from global vaults, commercial and investment banks are forced to adjust their market-making pricing, effectively raising the price floor for every ounce of gold in existence. For retail and institutional investors, tracking this evolution from Sydney, Mumbai, Dubai, or anywhere across our international community, leave a comment below sharing how your local currency has held up against real assets over the past year. If you are finding this breakdown insightful, take a moment to like the video and share it with someone currently evaluating their long-term wealth preservation strategy. Understanding these systemic mechanics is essential to navigating what comes next. What we are observing is an asset repricing model driven by a fundamental breakdown in the traditional relationship between paper interest rate policy and real commodity valuation. Historically, when central banks raised nominal benchmark rates, non-yielding metals faced aggressive liquidations as investors migrated toward cash and short-term debt instruments. However, in the current macro environment, nominal rate adjustments are routinely swallowed by structural fiscal inflation and persistent debt expansion. When market participants calculate real adjusted returns, subtracting systemic debt expansion and true inflation from nominal yields, they discover that holding paper currency or low-yielding debt continues to result in a net loss of purchasing power over time. As a result, gold's historical sensitivity to nominal interest rate shifts is broken down, allowing its price to break through $4,500, even while nominal interest rates remained far above their post-2008 lows. This dynamic creates a profound dilemma for central bankers and global policymakers. If monetary authorities attempt to suppress interest rates to keep sovereign debt burdens manageable, real yields plummet deeper into negative territory, accelerating capital flight out of paper currency and pushing gold higher. If, conversely, policymakers push nominal rates higher to defend currency value, the cost of servicing existing debt surges, exacerbating fiscal deficits, and triggering even greater borrowing requirements that ultimately end up back on the central bank balance sheet. It is precisely this structural feedback loop that institutional desks are watching so closely, and why the breach of $4,500 is viewed by macro strategists not as a peak, but as a symptom of an unfolding regime shift. What makes a $4,500 gold threshold truly historic is not simply where the price stands today, but what it exposes about the broader structure of global finance. When gold breaks through milestone levels of this magnitude, it triggers a chain reaction that forces institutional capital to rethink asset allocations across every major asset class. Equities, real estate, government bonds, and corporate credit are all priced in paper fiat. When the baseline currency measuring those assets declines in purchasing power, nominal values may continue to rise, but real inflation-adjusted wealth quietly erodes. Investors who focus solely on nominal gains often miss the reality that earning a 6% yield in a currency expanding its debt supply at 8% annually leaves them poorer in real terms. This brings us to the ultimate question shaping the modern monetary landscape. Is this milestone a temporary surge? Or are we witnessing the early phases of a permanent structural shift? While short-term market corrections are a natural component of any long-term rally, the underlying drivers of this movement, unprecedented national debt, persistent central bank accumulation, and accelerating sovereign currency, debasementary structural forces that cannot be erased by standard policy tweaks or routine interest rate cycles. As paper currencies face gradual purchasing power erosion, finite assets like gold, strategic commodities, and non-sovereign reserves are increasingly being reassessed as essential components of long-term balance sheet stability. Before we draw today's chapter to a close, take a moment to hit the subscribe button, like the video, and share this breakdown with anyone navigating these turbulent financial markets. And for our global audience tuning in from Riyadh, Frankfurt, Tokyo, or anywhere else worldwide, drop your location in the comments and let us know your thoughts on where the dollar and gold are headed next. The story connecting sovereign debt, currency erosion, and the repricing of real assets is still unfolding across central banks, bond markets, and institutional trading desks every single day. As the monetary rulebook continues to be rewritten in real time, staying ahead of these structural shifts is no longer optional for serious investors. It is critical. We will be tracking every signal, dissecting every policy decision, and connecting the dots right here as the next chapter of this global monetary transformation takes shape.